Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So it's pretty much conventional wisdom that a sequel is rarely as good as the original. I mean, there are some exceptions, right? I think the Indiana Jones sequels back in the day, I think they held up pretty well, but a lot of follow-up films, ugh. And when the original was awful to start with, well, we all know that the sequel is probably going to be even cringier. I've been saying for a long time that they are producing a sequel to the 2008 financial crisis and Great Recession. I remember that film. It wasn't good. The follow-up has been a long time in the making. There were some delays because of the Rona, but, production is ongoing, and that sequel could be out anytime. Okay, I have a confession. Sometimes I suffer from imposter's syndrome doing this job. Every week, I interview folks, and if you are subscribed to this podcast, you can also hear those interviews on our Market Watch podcast that airs every Friday. So that means every week, I'm talking to really smart, accomplished people in the world of economics and finance. I'm talking to people who've worked on Wall Street for decades, professors, mining CEOs, and then there's me. Now, don't get me wrong, I don't feel like I'm totally unqualified. I did go to business school. I earned a BS in accounting. And beyond that, I've spent decades studying economics, reading about the financial markets. I'm nerdy like that. But let's be honest, I don't have a PhD in economics. I never worked on Wall Street. I'm not a big-time trader. And I've really only been actively working in the gold space for a little over a decade. And on top of that, my insecurity is fueled by the fact that I'm not a mainstream guy. So, there's not a lot of people out there that I can turn to kind of confirm what I'm saying. So I spend a lot of time going against the flow. I'm sure that most of the talking heads on CNBC or Fox Business would just blow me off as some nobody with a podcast. None of that makes me wrong, though. And when I start seeing bigwigs out there in the mainstream making the very same points I've been hammering on this show, I do feel a little bit vindicated. Makes me feel good. And that happened this week when I ran across comments from JPMorgan CEO Jamie Dimon. Now, there's a name that the people on CNBC will take seriously, right? Now, before I tell you what Dimon said, let me thank you for listening to the show because I really do appreciate it. Because obviously, you're probably aware that I'm not this super famous economics dude, and I appreciate the fact that you find value in what we're doing here. And it means a lot to me that you do spend a little bit of time out of your day listening to the show. So thank you very much. Every week I ask for a favor. I'm going to ask again. I'll probably ask again next week, but I would really appreciate it if you would take just a second and write us a review wherever you're listening to this show. And, give us those stars, give us those thumbs up. And if you would share these episodes, I'd really appreciate it because, if you get value out of it, maybe some of the folks in your circles will as well. That'll help us to grow the show and it just makes it all the more worthwhile sitting behind this microphone every day. So again, thank you. And if you would do that, I would really, really appreciate it. So I have argued that the current economic environment has a lot of eerie parallels to 2006, 2007, early 2008. We have extremely high asset valuations. The economy is loaded up with debt, and monetary policy has taken a very similar trajectory to what we saw in those years leading up to the financial crisis. So we've got easy money blowing up bubbles. We even have some of the characters from that original, like Larry Kudlow out there talking up the economy, just like those guys did in 2007, swearing that this is the greatest economy ever, everything is great, there's nothing to worry about, nothing on the horizon, prosperity is going to go forever. And I'm not the only one who sees these concerning parallels. Now, of course, there's other folks that are in our circles that you might listen to that will echo what I'm saying. People that understand Austrian economics echo what I'm saying, but you're not going to hear what I'm saying, generally speaking, on Fox Business or CNBC. But Jamie Dimon, the JPMorgan CEO, recently said elevated asset prices and an increasingly competitive banking environment pushing more and more credit out there remind him of the pre-2008 financial crisis years. He sees a sequel in the making. Dimon said, quote, "My own view is people are getting a little comfortable that this is real, these high asset prices and high volumes, and that we won't have any problems whatsoever." But he warned that the cycle will inevitably turn. He said, "There will be a cycle one day. I don't know what confluence of events will cause that cycle. My anxiety is high over it. I'm not assuaged by the fact that asset prices are high. In fact, I think that adds to the risk." So when you hear people in the administration, you hear Donald Trump, pointing at the stock market, look, everything is great because the stock market is booming. Dimon says that is reason for concern. And he's also increasingly worried about the rising levels of debt, something that I've talked about at length on this show, right? We have government debt, well over $38 trillion of government debt. I wrote an article last week just chronicling how much debt the current administration has added just in the last few months, right? We hear about, spending cuts, and we heard about Doge. The spending is just going up. Now, this administration is fortunate, I guess it's fortunate, in the fact that there is a lot of tariff revenue coming in, and that's helping close the deficit modestly, but there's still a massive deficit. Every single month, this government is spending more money than it takes in. That's a problem. That debt is growing. And I've talked about at length why that's a problem. We have growing consumer debt. I read the other day that non-payment on student loans is at a record high. We have credit card debt that is through the roof. And then, of course, there's corporate debt. We've seen corporate bankruptcy levels at heights we haven't seen since the early 2010s. And despite all of the debt that's out there, we have a banking industry that is scrambling to make more loans. We have a central bank that has cut interest rates to incentivize more borrowing. So we're just feeding this growing debt black hole. Dimon said that he sees many lenders out there loosening lending standards in pursuit of profit, just like the run-up to the 2008 financial crisis. He said, unfortunately, we did see this in 05, 06, and 07, almost the same thing. The rising tide lifting all boats. Everyone was making a lot of money. People leveraging to the hilt. The sky was the limit. And this idea that everything is great, this just incentivizes more risk-taking. Dimon said that he sees people doing dumb things. He said they're just doing dumb things to create NII. He means net interest income. So they're loosening lending standards. They're chasing that interest income. Of course, loose lending standards, that leads to bad loans. Bad loans create malinvestments. Malinvestments ultimately unwind, perpetuating a crisis. Right? In 2006 and 2007, it was artificially low interest rates coupled with government policies as the government was trying to increase home ownership. A noble idea, but not good for the government to get involved because what did it do? It blew up a real estate bubble. And, as I mentioned, Dimon said he wasn't sure what would precipitate the next crash, but there's always something looming on the horizon. He said, quote, "There's always a surprise in the credit cycle. This time around, it might be software because of AI." And, I guess in that sense, it's a little bit like the dot-com bubble of the late 90s, where artificially low rates helped incentivize all of the borrowing that blew up that dot-com bubble that eventually collapsed, caused a big recession that set the stage for the run-up to the 2008 financial crisis. So, Dimon conceded that it's easy to get caught up in market mania, right? You watch the stock market going up and up and up. You see these new record stock valuations. And Dimon said, you feel stupid when everyone's coining money and everyone's great. And it does feel really good. And then when I think about all the factors taking place, I take a deep breath and I say, watch out. Okay. Quick side note here. I have a bone to pick with some of you people. The first comment on the article that I wrote about Dimon's comments was this, quote, "This coming from JPMorgan that has paid out around $20 billion in fines over the past few decades for manipulating the stock market and another $920 million for manipulating silver prices." Okay, with all due respect, what does that have to do with the price of tea in China? I mean, I get it. You don't like the big banks and the big bankers. Heck, I don't either. I don't trust them to behave as good actors. However, we shouldn't let that swerve us into logical fallacies. And arguing that we shouldn't listen to Dimon based on what his company did or didn't do isn't a basis for discrediting what he said. Right? One should always evaluate a message based on the message itself, not on one's perception of the messenger. Do you disagree with what he said? That's cool. If so, tell me why. But don't resort to ad hominem attack. Too many people take this intellectually lazy shortcut of ad hominem instead of engaging with the argument. I mean, I guess that's expected, right? In this increasingly polarized world where everybody seems inclined to line up with their team and believe virtually everything their team says and then disregard everything that the bad guys say. Just because they're bad guys, though, that doesn't mean that they're always wrong about everything. You know, there's a lot of people that I disagree with 99% of what they say, but that doesn't mean that there's not 1% at least that they might be correct and worth listening to on. You know, I just want to encourage folks to listen with an open mind, engage with facts and arguments, and try to pull yourself out of the cult of personality. I mean, yeah, Dimon might be a bad guy, but I think in this case, he's right on. And I mean, for whatever things that he's done wrong, he does have intimate knowledge of this industry, and I think his insights are valuable, and that's why we're talking about it today. And while we're on the subject, JPMorgan just raised its gold price forecast to $6,300 this year. And company analysts made a good case for $8,000 gold in the near future, arguing that gold is becoming the go-to safe haven. It's kind of usurping bonds. And, you know, we've seen this situation where we're starting to see people in the mainstream talk about a 60-20-20 portfolio with 20% allocated to gold. Currently, most people don't have any gold at all. And even people who have gold exposure in their portfolios, we're talking 1%, 2%, 3%. So if those percentages start to go up, we're talking about a significant increase in gold demand. And the JPMorgan analyst made that argument. I'll link to a report I wrote about it over at moneymetals.com/news on the show notes page. And, you know, while we're on the subject, JPMorgan just raised its gold price forecast to $6,300 this year. And company analysts made a case for $8,000 gold. And that argument is based on the fact that we're seeing more and more people considering gold to be an important part of a portfolio, right? We had the CIO over at Morgan Stanley talking about a 60-20-20 portfolio with 20% allocated to gold and precious metals. Currently, most people don't have any exposure to gold at all, and those who do, it's usually 1 or 2%. So if we start seeing people adding gold to their portfolios to get closer to that new 60-20-20 ratio, we're talking about a significant increase in investor demand. I'll link to a report I wrote about this over on the show notes page. You can find it over at moneymetals.com/news. So with that in mind, here's a question for you folks who at me about manipulation every time the gold or silver price drops. If JPMorgan has totally rigged the market and their people are saying gold is going to go up, perhaps as high as $8,000. Shouldn't you be gobbling up the gold? Because if they're manipulating and they're saying it's going to go up, isn't it in their vested interest to make it go up? Just saying. Okay, let's be clear here. I'm not saying that there's no manipulation. We know there is. But in my opinion, it isn't the dominating factor driving the markets, especially not the gold market. The gold market is just too big. Silver, more prone to manipulation because it is a much smaller market, and the paper pushers have an outsized impact there. But as I discussed on the show last week, the physical market is beginning to wrestle control away from the paper traders. And ultimately, any market is about how much actual stuff there is, right? The silver market is ultimately driven by how much silver exists and how much silver that people need. And in that situation, currently, there's not enough silver to meet all of those needs. Anyway, I'll hop off that soapbox. That's a little bit of an aside, but it just irks me. I get frustrated when I see somebody make an argument and then somebody else comes back, well, that guy said da-da-da-da, and da-da-da-da has nothing to do with what we're talking about. It's just sloppy thinking. Gets on my nerves. Okay, so back to the parallels between 2008 and today. On top of the similarities between 2007 that we've talked about and that Dimon pointed out, there are also parallels to 2019 that should raise eyebrows. And really, that's just kind of continuing this cycle. And I've talked about this. I've done a whole show on this, but I kind of want to recap what's going on because I think it's important. I think it's important to put things into broader perspective, right? We live in a world that's driven by X headlines and social media, right? What's the headline of the day? What did Trump say today? What did the Fed do today? And that stuff's important, don't get me wrong, but it has to be put in some kind of context. There's a bigger picture to see. And the things that I'm talking about here, these macro factors, these longer timelines are important to grasp. And again, there's a lot of things right now that looks like what happened in 2019. So in the wake of the 2008 financial crisis, we know that the Fed cut rates to zero, and they held them there for 7 years. The central bank also bought more than $3.5 trillion in bonds via quantitative easing. So they bloated the balance sheet, and they injected trillions of dollars of newly printed money into the economy. That fed this massive increase in asset valuations and debt that Dimon is worried about today. Because really, since 2008, they never normalized that, right? They've tried a couple of times, but, the balance sheet's much bigger today than it was even then. And the truth of the matter is the Fed didn't lift a finger to normalize monetary policy until 2015, so 7 years after the financial crisis. And it really didn't begin in earnest until a couple of years after that. Even with only modest monetary tightening in 2017 and 2018, the economy began to crack. The stock market tanked. The economy got wobbly. If you think back to that time, you'll probably remember the fall of 2018. There was a huge stock market sell-off, and everybody was worried. And it quickly became clear that the central bank could not normalize interest rate policy without crashing the economy because it had blown up another bubble. So the Fed just gave up. It was forced to cut rates 3 times in 2019. And it resumed QE that year, just like it did recently. So 2019, even before COVID, we were seeing this loosening of monetary policy because they were worried that the cycle was about to turn. And then the pandemic bailed the Fed out in 2020. It allowed the central bank to slash rates back to zero, to take QE to unprecedented levels, right? They added another $4 trillion to the balance sheet, more than that. And this kicked the can down the road, right? It gave the easy money addicted economy a surge of its preferred drug, and it kept that inevitable crash at bay. Were it not for the massive monetary injection during COVID, the economy would have likely gone into a deep recession then and cleansed out the monetary excesses of the Great Recession. Instead, the pandemic allowed the central bank and the government to double down with even more stimulus, and it basically just delayed the inevitable. So the reality is, this economy has to have its easy money drug. It's addicted. Without it, the addict goes into painful withdrawals. We call those crises. We call those recessions, maybe depressions. The Federal Reserve, the drug pusher in this scenario, has begun to dribble the monetary heroin into the addict's veins again, right? We've talked about this. We've had the rate cuts. We've seen the resumption of quantitative easing, even though they won't call it that. The problem is, over time, it takes more and more of a drug to maintain the high, and eventually the druggie will OD. So you're kind of trying to walk this balance, right? You want to keep the drug addict high enough so he's happy, but not so much that he overdoses. And you don't want to get him so low that he goes through withdrawals. So, in my opinion, no matter how this plays out, right, as we move ahead, we're looking at an increasingly inflationary environment. The money supply is already growing at the fastest rate since July 2022 in the early stages of the tightening cycle, and the pace of money creation will increase as the Fed continues QE without calling it QE. And we'll also likely see additional rate cuts, right? We've heard about how Kevin Warsh is going to be a more hawkish Fed chair, and yet they're still expecting 2 more rate cuts this year. It's not like interest rates are high now, right? I've talked about this ad nauseum, this catch-22 that the Federal Reserve is facing right now, where it simultaneously needs to keep rates higher to keep inflation at bay, and also cut rates because we have this debt black hole. We have this looming situation that Dimon is talking about, right? So that means you can look forward to the purchasing power of your dollar declining even more rapidly. And of course, this will add even more fuel to the fire that Dimon is already warning about. So plan accordingly. By the way, one way to plan is to get some silver. And the cheapest way to do that right now is to pick up some junk silver. I'm talking about pre-1965 dimes, quarters, and half dollars, right? Before 1965, our coinage was 90% silver. Now it's 0% silver. And as of yesterday afternoon, the melt value of a quarter that is 1964 or older was $15.79. And here at Money Metals, we are selling junk silver for as much as $3 below spot price, depending on the quantity. So go to moneymetals.com and you can click on the silver link, or you can click on the specials. There's a banner on top with our specials. If you go to either of those places, it will take you to where you can find out more about purchasing junk silver. It's a great way to add silver to your portfolio. I like junk silver because it's kind of my, zombie apocalypse plan, right? Because quarters, dimes, half dollars would be very easy to barter, right? If I have a quarter that's made of silver, somebody knows that value, I've got $15 in my hands. So I love junk silver, and now's a great time to get it. So we've talked about the parallels between 2008 and today. And I think that this is a legitimate concern. I think we're heading down the same path. It's the business cycle. And folks who are aware of Austrian economics and the Austrian business cycle understand exactly why I'm talking about this. I'm sure Dimon knows what the business cycle is. I'm not sure that, I don't think he's an Austrian economist in any sense, but he sees it too, right? So I think there's something to this, and it's something that we need to really be watching, because right now we're in that phase. Everything is great, right? I did not watch the State of the Union yesterday, but I guarantee you that at some point Trump told us how great the economy is, and it's easy to be fooled. So just watch out. I want to wrap up the show and talk a little bit about platinum. I talk about platinum from time to time on the show, not as much as gold and silver, obviously, because platinum is not so much a monetary metal, although it kind of hangs out on the edge of the monetary metals. I think it is influenced by the broader precious metals complex. But it is an interesting metal, and I think a lot of people like platinum as kind of a diversifier for their precious metals portfolio. And somebody asked me the other day why platinum isn't surging like gold and silver. And honestly, it actually has. it did better than gold last year. But its recent correction was deeper and its recovery has been less than gold and silver. So I understand why the person asked this question. It does seem like, especially over the last couple of months, that maybe platinum has underperformed gold and silver. So according to the World Platinum Investment Council, and I'm just going to refer to those folks as the WPIC, after getting caught up in precious metals mania, the recent price drop brought platinum more in line with fundamental market dynamics. So in other words, it got a little ahead of itself. It got a little high in the price. And with the recent correction, it is now more in line with what the WPIC is kind of the right price considering where we are in the market. Now, platinum joined gold and silver for the wild ride up in 2025. Platinum gained 119% last year, 119% gain. And then it continued to surge through the first 3 weeks of 2026. Platinum hit an all-time high of $2,923 an ounce in late January before selling off along with gold and silver. And over the past few weeks, platinum has rallied, and it seems to have found a support level around $2,000 an ounce. So kind of followed the same trajectory as gold and silver. Big sell-off, substantial price decrease, and then a little bit of a recovery, a consolidation, and now we've kind of found this support level. For gold, it seems to be around $5,000 an ounce. For silver, it seems to be around $86, $87, $88 an ounce. And for platinum, we're at $2,000 an ounce. So while that sell-off was substantial, the platinum price is still up 112% since January 2024. So actually up on the year slightly. The World Platinum Investment Council analysts say that despite the recent correction, quote, the factors underpinning platinum's all-time high price remain entrenched. Quote, the price increase has not solved for the ongoing shortage of metal, which is illustrated by sustained high lease rates and strong over-the-counter backwardization. So based on the WPIC's Platinum Price Attribution Model, PPAM for short. So this is just a model that the World Platinum Investment Council uses to kind of figure out where the drivers are for the platinum price, which dynamics are driving the price currently. And according to this PPAM model, the price became significantly disconnected from market fundamentals in late December and early January. WPIC analysts say this was likely due to the platinum market being caught up in the broader precious metal bullishness and driven by, quote, the significant impact that the macroeconomic and geopolitical environment was having on commodity markets. The WPIC went on to say platinum's early price momentum increasingly began to disconnect from the expected price derived from our PPAM. The residual factor, i.e. unexplained price drivers between spot and our PPAM, exceeded $500 an ounce by January 26th, when platinum achieved an all-time high of $2,923 an ounce. Analysts say that the recent correction and consolidation has brought the market more in line with traditional drivers. Quote, in our view, platinum's mild price recovery in February likely reflects some consolidation, with investors returning their focus to tangible market dynamics, such as platinum's elevated lease rates and compelling supply-demand outlook. And it's a lot like silver. This supply-demand dynamics are really a key thing that's underpinning platinum and will likely continue to as we move forward. Because much like silver, the platinum market faces a structural deficit with demand outstripping mining and recycling supply. So in 2024, the platinum market ran its third straight supply deficit with a 995,000 ounce shortfall. So what I'm saying there is that the demand, the used platinum, exceeded what was mined or created by recycling that year. So when that happens, when you have these market deficits, it's not like they're just out of platinum. There are above ground stocks, but those above ground stocks have to be tapped into. So basically you're tapping into your reserves, right? So the final numbers aren't in for 2025, but the WPIC projects a slightly larger deficit last year than what we saw in 2024. But then in 2026, this year, they expect the market to roughly balance with supply and demand kind of equaling out. And then the WPIC projects modest market deficits in the 300 to 400,000 ounce range through 2030. So what all of that says is that we're going to continue to see a shortage of metal. We're going to continue to see a shortfall, and we're going to continue to see folks using platinum, the jewelers and the mints, and of course the significant industrial users. They're all going to have to tap into those above ground reserves, and usually that requires a bit of a higher price. So kind of looking at the broader platinum market, the WPIC identifies 5 factors that it says will continue to support the platinum price in the near to midterm. Number 1, the ongoing supply shortfalls that we just talked about. Despite roughly balancing in 2026, the platinum market is expected to return to modest deficits in 2027 and beyond. And according to the WPIC, the balanced market this year will not alleviate current market tightness. Number 2, supply issues have more than one driver, right? Both primary mining and secondary recycling supply pose challenges. So basically, we're just not producing enough metal. And it's not just mining, it's not just recycling, it's both of those factors. Number 3, tariff issues. U.S. tariffs present some downside risk to demand, but these will likely be offset, according to the WPIC, by tailwinds created by jewelry demand and Chinese investment demand. It's interesting because platinum jewelry demand has surged with the price of gold going up. I remember back in the 80s when platinum was what you wanted. Platinum jewelry was better than gold, right? It was the platinum standard. And at the time, platinum was actually more expensive per ounce than gold. Of course, today that's different. But as gold has gotten more and more expensive, more people are turning back to platinum as a go-to jewelry metal. And so we're seeing a lot of jewelry demand pick up. And then there's also a lot of Chinese investment demand in platinum, because I think they understand the ramifications for industrial demand. Okay, so number 4, elevated lease rates and over-the-counter London backwardization. Talked about this earlier. These dynamics are just signs of tight market conditions, and we're still seeing that today, even with the recent correction. And then finally, the platinum price remains significantly below the price of gold. And as I've already alluded to, before 2011, platinum was generally more expensive than gold. This trend reversed in 2015, with the spread between gold and platinum actually growing wider. So, it remains to be seen whether platinum will ever regain price parity with gold, the way that we saw before the mid-2010s. But given the supply and demand dynamics, it is reasonable to be bullish on platinum in the near to mid-term. And as I mentioned, platinum is a great way to diversify your precious metals holdings. And we do sell platinum products here at Money Metals, including IRA-eligible coins and bars. And if you go to moneymetals.com and you go up on the top and you can click on the banner, you'll see other metals up there, and you can press on that and you will see the products that we offer in the realm of platinum. And if you have questions, you want to talk about it, you want to kind of figure out how platinum might fit into your portfolio along with gold and silver, or maybe you're hearing about the rapid rise in the silver price and you're thinking, man, I want to get some silver. It's the first time I've ever invested in precious metals. I have questions. Well, give us a call. 800-800-1865. Talk to a Money Metals precious metals specialist. I tell you every week, these folks are fantastic. They're knowledgeable. They love talking about gold and silver. They love answering your questions. They love helping you out. So give them a call today. I know some folks don't like to talk on the phone. You don't have to. You can go to moneymetals.com. You can chat online. Or, if you know what you want, you're like, man, I'd like to get some platinum eagles. You can do that. Just go to moneymetals.com. You can click on the item that you want to purchase. We'll get it shipped out to you. And if you don't want it shipped out to you, we will store your metal in our state-of-the-art bullion depository. So give us a call today, 800-800-1865. Now's the time. As I keep saying, the powers that be are going to continue to devalue your money. No matter how all of this, macro situation plays out, whether there's a financial crisis or not, I can guarantee you that the U.S. government is going to continue to devalue your money. That is the plan. That is the stated trajectory. So do it today. Give us a call. So that's going to be a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today. And of course, a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up, join a million other people, and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, make sure you tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. As always, thank you so much for listening to the show. Give us those thumbs up, share the episode. Thank you again. Have a fantastic rest of your week, and I will be back again next Wednesday.